Bruce, thank you very much, and good evening, everybody. Maybe I'll just go into that story that Bruce talked about first, about our value acquisition of a original 1934 edition of Security Analysis. I had always thought that it might be nice, because that is the Bible of value investors, Security Analysis 1934. It might be nice to have a copy of it, but I started looking around for a copy of it in the early 1990s. However, I was finding that original editions were quite expensive. And as you know, value guys do not like to overpay for things, even though it's kind of hard to determine what the intrinsic value of a book is. But we think the intrinsic value, of course, was quite high, but not as high as it was priced at the time. I think there were quotes around $40,000 or $50,000 for this book, and I decided that that was even higher than what Ben Graham was worth, although I probably was wrong on that one. But in any case, along a few years later, of course, along came the Internet bubble. 1997, 1998, 1999. Graham and Doddism, value investing then was finished, absolutely done. We would have clients tell us during that period of time that if you have no technology stocks and no internet stocks, that's where the whole world was going. How could you possibly be an investment management firm and not own any of those stocks? Because we didn't. We didn't own any of those. And I couldn't have been happier by that talk about us, by the way, and I'll go back and explain some of that a little bit later. But at that point, if you were to look for original copy Security Analysis, we just started to look again, we found a copy of the book from a professor at the University of Kentucky who had it for sale, and he said, well, I'll sell it to you for $10,000. Well, of course, as value guys, again, we weren't willing to just settle on that price. We were patient. As you can tell, we've been patient for a long time. And so we've continued to be impatient. One of our security analysts was on this case for me. Joe was working on this. And so he went back to this gentleman and offered him like $2,000 for the book. And make a long story short, it came out that we bought this particular original edition, 1934, for about $4,500, I believe was the price. And then, of course, as you all know, the Internet bubble, which is the craziest thing I'd ever seen in my investment experience, completely broke. And instead of the technology and the Internet stocks being absolutely everything for the future, the Graham and Dodd type of stocks that we were buying, companies, finance companies, banks, insurance companies, industrial companies, all started to really perform. And so the Graham and Doddism, buying value, buying things cheap on book and price to earnings and price to cash flow, come back into style again. And so I understand that, and I haven't priced the book lately, but it was around after the bubble was over and value was coming back, or I did price it around year 2002, 2003, and the price was already back up to $30,000. And so this was kind of an indication of how crazy markets can be, and how crazy not only markets for books can be, but for markets for stocks and everything else. So what I'd like to do this evening for you is go back and talk about some basic principles rather than get into a lot of details about security analysis. Maybe we can do just a little bit of that later. But I think the basic fundamental thing about investing, especially value investors, is number one, it's a very obvious, very simple thing to do. There's nothing terribly complicated about being a value investor, number one. Number two, though, in actual practice, it becomes extremely difficult. Of course, if it was all that easy, everybody would be doing it, and there wouldn't be value stocks out there anymore. And so I think that I would like to, therefore, this evening go back and explain a little bit to you about the markets and human nature as we see it as Graham and Dodd value investors, and what you need to do to actually put into practice these basic fundamental conservative principles, but actually have them work for you in an investment program. Just a little bit of history going back. In 1968, when I finished graduate school, I did become a stockbroker because I didn't want to live, I shouldn't say this, I didn't want to live in the cold climates anymore. And I couldn't find any good finance areas of the world where you could have nice, balmy, warm weather all year long. So I decided, well, I can't become an analyst. I can't, work for a bank, an investment banker, and I would have to be working in a place where it's a little chilly for me, like Toronto or New York or London. And so I decided, well, I'll just become a stockbroker. And in 1968, I did. Now, what was interesting here, and what's really good for me, is that this was a era called the go-go era, 1968. The go-go era meant that you had all these very famous investors who, for 1 year period of time, 1967, had made more than 100% in their investment portfolios. Everything was very easy to do. There were a lot of IPOs. Electronic stocks were very popular. It didn't matter what you paid for these companies because they would grow forever. And this is the atmosphere I came into, and I really didn't know any different. I hadn't had any experience, and I thought, boy, this is kind of great. These people just make money hand over fist constantly. In 1967, Fred Carr, running the Enterprise Mutual Fund, was up 117%. He was considered a god, but what was thought when I came into business in 1968, well, you can't do 100% a year, but a lot of clients felt that you could do 20, 30% a year compounded, go on forever. And that's the kind of atmosphere I was in at the time. I didn't know any better, so I didn't have any kind of basic investment conservative philosophy myself, but I wasn't really comfortable with stocks like Mini Pearl Chicken, as an example. Mini Pearl Chicken had 4 fast food chicken stores. They came public, raised around $400 million, and you can understand 1968, that was a lot of money. And I wasn't really comfortable with the fact that Mini Pearl Chicken would double and triple from its IPO on that day, but I didn't know any different. Very fortunate for me, came along 1969, 1970, which was a very severe bear market, and people like Fred Carr and the go-go era people got wiped out totally. Then one day I was a stockbroker in La Jolla, California, which is the town, a suburban town just north of San Diego, and wasn't doing any business because right after that major bear market, nobody wanted to have anything to do with equities or stocks or anything like that. But an older gentleman walked into the office, and I was the stockbroker of the day, and he wanted to open an account. Turns out his name was Benjamin Graham. He lived in La Jolla part of the year. So I was the stockbroker for one trade for Benjamin Graham, and then he came in and purchased 1,000 shares of National Presto Industries. Now let me tell you a little bit about National Presto Industries. It was a net. This is one of Ben Graham's premier techniques of investing conservatively, but getting adventurously and getting high rates of return. He developed this in the 1930s when there were actually many companies selling in 1932, 1933 below their net cash. There were companies selling at half of what their cash on their books was worth minus all their liabilities. And he developed this technique called the net. Buying them at 2/3 of net current assets. You take the current assets minus all the liabilities. So he came in with National Presto Industry because it was an example of a net in the last edition of The Intelligent Investor, 1972. that was produced before Graham passed away in 1976. I looked at this and I said, well, gee whiz, I've seen the go-go era get wiped out. I've seen the go-go era come and be very exciting. Maybe I should go back and read Ben Graham. As soon as I went back after that experience and read The Intelligent Investor and went back and looked at the security analysis textbook, I said, absolutely, this makes a lot of sense. It is conservative. It is actually fundamental and not speculative. And lo and behold, because you're not doing what everybody else is doing in Bay Street and Wall Street, you have a very good chance for success. If it is something they don't do, but something that is fundamentally sound. And then I went back and looked at the track record of the Graham and Dodd guys up until the early 70s there, and they were all, over a long period of time, superior, successful. So I decided to adopt this lock, stock, and barrel. But I was in deep trouble again because this was 1972. 1972 was the Nifty 50 era in the stock market. Nifty 50 era meant that there were 50 great growth companies in the world. These are the only companies you should ever buy in an investment portfolio. It makes no sense to be concerned about the price you pay for these companies because they will grow forever. That was the thought, that growth would be, and these companies were so strong, they would grow forever. And of course, mathematically, as some of you might know, if a company is going to grow forever, doesn't matter what price you do pay for it. But of course, as the experience shows us, no company, no matter how good they are, always grow forever and are around forever and have that rates of growth. So I was kind of lost again. The Nifty 50 were trading at 30, 40, and 50, 60 times earnings, 10 times book values, and some of the biggest investment managers in the world were just buying the heck out of these companies, and I wasn't comfortable. I was a Graham and Dodd now. I couldn't possibly pay those prices for it, so what was I to do? Very fortunately, 1974 came along. We had another major bear market, and this was something I remember talking to Ben Graham around about the Nifty 50 in 71, 72, 73. He said, this is going to come to a bad ending because this doesn't make any sense to him. And it did. Nifty 50 stocks, as an example, Avon Products was a Nifty 50 stock. It went from $105 to $4 a share. And so that's what happened to that great concept. But at that time, 1974, stock prices were so low that I had a great opportunity, and so that's when I started this firm based upon Graham and Dodd principles on a global basis. Kind of another interesting story. My first client was actually a gentleman from Vancouver who lived in San Diego part of the time and had, of course, a business in Vancouver. Of course, he had the timber business in Vancouver, but he had sold it and retired. And so my very first client as a investment manager was a Canadian. This type of story like this, as far as stock markets go, continues to repeat itself over and over again. And when anybody tells you it's different this time, you cannot believe them. As a true Graham and Dodd, you know that there is nothing different about what happens in the public stock markets. Just the names change, the marginal circumstances change, but it doesn't change that rapidly from the standpoint of what good investing is compared to what speculation is. And I've seen this now continue to repeat itself over and over again during my career. Just briefly to go over that, of course, we had the rest of the decade of 1970s, when I started firm 74, was not really good for stocks, and if you look at the indexes from the beginning of the 70s to the end of the 70s, the indexes didn't go anywhere. Of course, value investors were doing pretty well during this period of time. But I remember Business Week magazine in the U.S. in 1979 came out with a cover story. It said, "The Death of Equities." They said it makes no sense anymore to ever invest in equities. This is the way style goes up and down. Then I looked a few years ago, the rate of return in equities, and I just looked at the S&P 500 index at the time, what it had done since Business Week magazine came to the conclusion that there was no future investing in stocks or equities ever again. And it came out that they had compounded about 17% a year throughout all those period of years when they were predicted of being very, very poor investments at the time. So I think that it's very conservative, very fundamental, and the first chapter of the Intelligent Investor book by Benjamin Graham is entitled Investment versus Speculation. And I would encourage you to, just on that first chapter, to think about what he said in there again. And this is the chapter where he talks about the fact that the market is crazy most of the time. And he talks about the fact that you should not invest in the stock market. And you shouldn't even think as an investor about the stock market or the bond market. And you should only think about the fundamentals of the investment that you are actually making and whether that makes sense over a long period of time. We get involved, and most people get involved in thinking and getting confused about the difference between investment and speculation. And anytime, as an example, you see talk on the nightly business report or something, well, where is this stock price going to go in the next 6 months, or where is interest rates headed right at the present time? Where's the gross domestic product growth going to come from in the next year or two? The stock market, how is it going to, is it going to go up from here? Or is it going to go down? What's next quarter's earnings going to be for ABC Inc.? Ben Graham had pointed this out, and a lot of people don't understand this. Anytime that you're talking about that type of thing, you are not an investor. You are actually a speculator on trying to forecast unforecastable events in the future. And you are trying to think in much too short a period of time as an investor. If you think about what an investor would do on a private basis rather than investing in public bonds or stock market, is he going to think about buying a private business where he would own 100% of it for its earnings over the next quarter? Or is he going to think about it because of somebody is going to, in the Federal Reserve, change interest rates? So is he going to think about not buying that business or something like that? Of course not. He's going to think about the price that he has to pay for that business to buy all of it. He's going to think about long-term, the future of that business. He's going to think about what cash flows would come out of that business, how much cash could he take out of the business over a longer period of time compared to the amount of cash he has to put into the business to keep it running. That's what you would think about when you're a true investor. And if you think about anything else, you're a speculator. And Ben Graham, in his first chapter, he puts it in the first chapter of Intelligent Investor because it is so important to understand what you are thinking about. And it's so important to understand whether you are really an investor or whether you are a closet speculator in stock prices and in forecasting any kind of interest rates and things like that. I would almost even say that in Canada, of course, you have a lot of exposure to basic materials and oil and gas prices and all this sort of thing. We as analysts in the oil and gas industry, and our oil and gas analyst as an example, is not going to make a forecast on the price of a barrel of oil over the next year or two when he brings this to our investment committee for us to decide whether we want to put that company in our portfolio or not. And he better not bring that type of thing, because that is not basic investment fundamentals. The price of oil on a short period of time is unforecastable, and I will make that statement. And the people that can do it are the lucky people. You don't hear about the people who have been wrong about their forecasts on commodities and basic materials, on oil and gas and that sort of thing. And today, of course, in the last year, it's been, all the forecasts have been that oil and gas, well, it's going to do nothing but go up, obviously. Everybody knows that, right? The only thing we can do as analysts is take a look at the long-term basic history of the fluctuations, as an example, in the oil and gas prices, and normalize those fluctuations and try to come up with what we call a normalized price on that. We know we're going to be wrong. You have to understand that you are going to be wrong when you make a lot of these guesstimates or estimates, and that's the reason why, as a value investor, you've got to be conservative in your estimates of what you think might happen in the future for this company, or what's going to happen in the world. You just take, and we do this in our investment committees, we take a discount, we take a conservative outlook when we place a value on a company, and then from Ben Graham's teachings, we take another discount, and that is called the margin of safety. The margin of safety is the basic principle of investing, and it was put forth, of course, by Ben Graham, and stated by Warren Buffett, the most successful investor in public markets of all time, that it is the basic principle that you must follow. And the margin of safety is another discount, because you don't know what the future is going to bring. You don't know where oil and gas prices are going to go, and because of that, you must have a discount to take into account future adverse developments that you are not able to forecast, and that is called the margin of safety. And Ben Graham has put it forth as usually a third discount from what you think is an intrinsic basic value for that company. So things never change. As far as the stock market being wild, crazy, and stupid, and something you should never pay attention to, and something that you should only pay attention to fundamentals. Going back a little bit more, 1987, stock market in one day, I think it was October 19th, 1987, dropped 22.5% in the S&P 500, one day. This kind of put the kibosh on the efficient market theorists who said the market prices are always right. They had a hard time explaining why on one day market prices could be worth a certain amount, and the next day it could be worth 22.5% less in one day. All the companies in the index were worth, from one day to the next, 22% less one day. Well, that hardly makes any sense, but that's kind of what the efficient market theory says. As a practitioner all these years, I believe exactly the opposite, that prices in public markets are wrong most of the time. They're not right. And when they're wrong enough, you can get that margin of safety. And when you can get that margin of safety, the odds are in your favor in your portfolio if you can have the patience and the long-term thinking to buy companies, especially companies that are out of favor, especially companies that nobody likes, especially not have in your portfolio. Oil and gas stocks, as an example, at this time. That is the human behavior part of that, an example, not having oil and gas stocks in your portfolio now when all your clients and all your friends and all your compatriots say, you don't own any oil and gas, you got to be nuts. Don't you know where the price of, don't you know how much these companies are going to make? And we go back to them and say, well, don't you know that the price already discounts that you would have to pay today? And so it takes a lot of fortitude to be able to be a Graham and Dodd investor and a value investor, and to buy things like the automobile industry stocks, where over the short period of time you're going to really potentially look stupid. You could also be perceived over the short period of time as being stupid when those stock prices go down from your initial purchase price. And so that's why, even though Graham and Doddism is fundamentally just a very basic type of thinking on analyzing businesses, and there's no magic formula or anything coming up in Graham and Doddism that gives you the magic rates of return. It's basic fundamentalism, but number two, it's very difficult to do emotionally, and it can be very difficult to own, as an example, no oil and gas in your portfolio and a lot of automobile stocks and auto part companies in your portfolio at this time. But you have to be able to do that as a true successful Graham and Dodder, and you have to be able to think that you don't care where, after you purchase this stock, you don't care where the stock price goes. Because the market is wrong most of the time. And you especially don't care where it goes in a short period of time. You don't care where it goes in 6 months, a year, maybe even up to 2 years you don't care where it goes, because the odds are in your favor that eventually, it might be 3 to 5 years, it might be even longer, that stock price is going to reach what you determined as the true value of that company. And therefore, when you compound, when you think of your rate of return, even though you've had to own the company for 5 years, if it's doubled in value, you've gotten a decent 14, 15% rate of compounded rate of return. And there are very few people that can consistently compound their money at those rates. And if you can, and starting at your age right now, if you compound your money at those rates, you will be very wealthy, very wealthy. You've all seen the compound interest table, so you don't need to actually knock the cover off the ball every year, because you can't do it. It's not be able to be done. But if you can get decent rates of return, even 7, 10, 12, 13, 14% rates of return compounded, which has been true of value investing over a long period of time, then you're going to end up very, very wealthy. It's not easy to do. I just might mention, before I might open it up for some questions or some comments or something like that, I might mention some of the studies that have been done. One is an extension of a study that we've done at the Brandeis Institute, which is our research study group here at the firm. But this study was originally done by a firm by the name of LSV in 1994. And the study they did was to take what they called the glamour stocks versus the value stocks. And the glamour stocks were those who were in the top 10% or the top decile of high PE ratio or high book to value ratio, or in another third part of it was high price to cash flow ratios. And the value stocks, of course, were in the bottom decile, bottom 10%, lowest price to book, lowest PE ratios, lowest price to cash flow. And they did this study buying portfolios of the glamour stocks and buying portfolios of the value stocks, and following these portfolios over a 5-year period on a rolling portfolio basis. and they would make up a new portfolio each year of the top glamour companies and the bottom value companies, and then roll them forward for 5 years. And the results came out that value beat glamour by about 600 basis points a year. We at the Brandeis Institute updated that study. Their study ended in 1994. We updated that study, not only for North American stocks, but we went worldwide and expanded the study into the international markets. And our results showed that value versus glamour in the international markets actually outperformed by a little bit more. And depending on whether it was large capitalization stocks or smaller cap stocks, the large cap stocks actually, during the period of time that we studied it, which I believe was 1985 through 2005, the large cap international value stocks outperformed the glamour stocks by about 1,200 basis points, or 12% a year. In the overall index, with all the different size companies in there, it outperformed by about 700 basis points, or 7% a year. Now, some people will tell you that, well, maybe that is true. The statistics that you were very careful in your study. It looks like that was true, but what's wrong with your study is that the value stocks have a lot more risk than the glamour stocks. That is one statement that has been made. And I have to really laugh at that statement because I think the exact opposite is true. You know, the way risk is defined in our world is wrong. But the way they've had to define risk to be able to put numbers on it is define it as volatility. One of the stories that Warren Buffett has said about 1974 is kind of interesting, and that was about his purchase of the Washington Post newspaper, public stock. He would do a basic fundamental analysis. At that time, of course, maybe today newspapers are not quite as strong as they used to be because of all the other alternatives and the internet and that sort of thing. In those days, they were very, very strong business and monopoly, more or less, businesses, and just tremendous amounts of free cash flow and all sorts of things. And Warren Buffett, I think he bought the Washington Post back then, and it was the total market capitalization was around $400 million, and he thought on just basic fundamentals and cash flow and earnings and potential growth and past history and the basic of the newspaper industry in general, that newspaper would be worth over $1 billion. And he said, however, in 1974, when these stocks went down and the Washington Post went down in price from $400 million to around $300 million or $200 million, you would be called a speculator, and that would be called a very risky stock because of its volatility. And he said, this is the craziest thing I ever heard of. You've got a company worth $1 billion, and it declines by a couple $100 million. It isn't riskier then. It is a much better investment with very little risk whatsoever to it. So that's the kind of trouble that we can get into in defining risk, and especially trying to put a number on defining risk and defining risk as volatility. I would recommend that you always have a grain of salt available when people or Wall Streeters or analysts or anybody tells you about risk and what risk you are taking, and defining it, which they always do, as the volatility of the particular asset that you own and the price differences that are being seen there over a short period of time, defining that as risk. It's just crazy. I think maybe I've gone on long enough just to give you a few ideas of the basic fundamentals of being a true investor. And I think it might be nice now to open it up for some questions. I'd be very happy to take those, or any comments that you might have. Do we have a volume?
Hi.
I'm sorry, I'm having difficulty hearing.
Hi, my name is Tom. I have a question regarding the startup companies, the companies that they don't have any track record, like, I don't know, pharmaceutical, they have like a high R&D cost, and probably they never get break even yet. So how you actually truly want to value, intrinsic value for these companies, or ever you look at this type of companies or not?
Yes, Tom, thanks. That's a good question. We do look at those types of companies. Generally, though, we are going to stay away from them because of that lack of history and lack of the ability to analyze the normalized wealth-producing capability of that business. So when we do look at a potential IPO, if it's in an industry that we understand, if we understand the basic fundamentals of the company and the potential there, we might look at it, but it all depends upon the price. What generally happens in IPOs is that the price is too high for a value investor. What generally happens is you don't have that margin of safety. And that's very explainable why, because the people who are selling their interest in the company want to get as high a price as possible. So you don't have the opportunity to get the market inefficiencies in those prices that are created by outside crazy market participants, people, and are created by near-term scares or something like that. Because, of course, if there is a near-term scare for a company, as an example, they're not going to come public. And so you don't have that opportunity. But occasionally, it's very rare, but occasionally we'll find a company that is coming public that at a price that we might be interested in owning it, but it's extremely rare. Occasionally, too, on the other hand, we will see secondary offerings of stock in a company that has existed for a while. And those have much more potential value for us than an IPO.
Hi, my name is Alex, and I'm just wondering what kind of margin of safety do you personally use, and what kind of markets are you seeing value in these days?
Yes, okay. Well, the kind of margin of safety I personally use are the same margin of safety that we use in the firm, and that our investment committees use. And this is an interesting question, and the detail would be quite long on this. The basic principle, of course, is the one put forth by Ben Graham. You buy them at a third discount. That's your margin of safety. We would like to always see a minimum margin of safety, if we could, of a third. Can't always get that. And we are under the problem as a portfolio manager and hired by our clients to be fully invested 100% of the time. Because what happens is that our institutional clients and our private clients are generally handled by consultants who hire money managers, and the consultants will hire 2 or 3 or 4, or the big pension plans will have as many as 14, 15, 20 different money managers to do various specialty items for us. We, as a money management firm, would get hired as a specialty in value equities, and so they want us to be 100% invested at all time. So be able to do that, sometimes we have to compromise a little bit on margin of safety, and we might have to buy it at a 20% rather than a 30% margin of safety to fill out our portfolios. But we also don't adjust really in investment committees the margin of safety that we require, but we adjust what the intrinsic value we put on the company that we acquire, depending on what kind of business are they in and what kind of business are they, and what location they are. If they are an emerging market, and in Brazil, for instance, in a Brazil telecommunications company, from the intrinsic value standpoint, would be valued lower than a telecommunications company based in Canada. And so that takes into account maybe a further discount that we would put just fundamentally on the company. But then if it was a Canadian company or a Brazil company, we would always want to try to achieve a 20%, 30% margin of safety.
Hi, my name is Ryan. I know your specialty's in equities, but I'm wondering if you could make a comment about the real estate market. In the last 8 years, we've seen a 73% rise in prices of real estate in the U.S. and 47% in Canada. I'm wondering if you sort of see this as a bubble similar to the tech bubble, and if so, do you expect a sharp price decline coming out of the next couple of years, or based on the fundamentals of real estate, will it be sort of a more gradual trail off?
Yeah, okay, thank you. Let me tell you what I thought we were doing, so then you can put my answer into context. I thought about 2 or 3 years ago we were in a bubble. And I thought that the stock prices were topping out at that time. How wrong was I? Quite wrong. And so I still think we're in somewhat of a bubble. But I've given up forecasting real estate prices, so I'm sorry because I've been so wrong that I refuse to answer your question and to have everybody be well aware of how stupid I am in predicting those prices.
Thanks.
We've had, I guess if you look at the news lately, and I thought this would be normal, we're starting to see right now some weakness in real estate prices. I was talking on Sunday to a commercial real estate person who's quite professional, been around for a long time, and involved in San Diego and Los Angeles commercial real estate. And he said, these prices make no sense because the rates, the lease rates that you're getting are have no relationship to the price. The price is so high, you're not getting a reasonable rate of return. He didn't tell me what rates of return you were getting, but I think it's more like 2 or 3%, and it just doesn't seem on a fundamental long-term basis make any sense. And he said he'd been around for a long time in commercial real estate, and he's seen these commercial buildings anyway at the prices they were trading at compared to their lease rates. It just doesn't make any sense. Yes, another question?
Hi, Charles. My name is Joseph. My question is, you spoke earlier about your firm dealing with emerging markets. How would you deal with countries which don't conform to GAAP accounting standards? How does that factor in your calculations of intrinsic value?
Yes, okay, good. Emerging markets. We will invest in countries, and most countries, not even just emerging market countries, will have different accounting principles and do some different accounting things. Some of them are just not wrong, they're just different from international accounting principles. Others, of course, you have to be very suspicious. And getting into some emerging markets, you have to be suspicious of the accounting. But I might make one comment about that before I say what we do about it, and that is we are, as analysts, we're suspicious of accounting, whether it's the U.S., Canada, the U.K., Germany, or whether it's China or Russia or Brazil or Indonesia, we're always suspicious of accounting. But there is an element in emerging markets where you have to be just a little bit more suspicious, and when we are, we do look at all the sources of the accounting. We kind of figure out from the basic fundamentals of looking at revenues and things like that, how far off their accounting might be. We do look at what they say their accounting principles are and see what they've left out and that sort of thing. And what we will do when we come up with intrinsic value, if we think the accounting maybe is okay, but we are a little nervous about it, we will we will downgrade what we come up with an intrinsic value for that company because of that. In some cases, we will do what we call red light. And what red light means is we don't know enough. And the accounting that we've been able to figure out, we can't figure it out. And we don't know what they're doing. And in that case, we just move on. If we can't understand what's going on, and this is a basic investment principle you should keep in mind, if you can't really basically understand what's going on, if you're hearing a lot of stories about how great things are or something like that, that's when you really should get quite suspicious. Or just from the fundamental standpoint, does this really make sense in the way a business like this would really work? Does this make sense that customers of this business would pay this amount of money, this sort of thing? So you have to go back to some of the fundamentals. And if it doesn't make sense to you, it's better just to move on, try and find an investment somewhere else.
Hi. I had a question about how you try to hedge yourself against foreign currency exchange risk. I know Warren Buffett has bet a lot against the U.S. dollar, and how do you handle that in your firm, and how would a person individually, you think, handle risks like that?
Yeah, good question on hedging. We don't hedge. And we've found that as basic long-term fundamental investors, and I'm talking long-term, it's too expensive to hedge versus the advantage you get from it. Now, if you are really concerned about short-term currency volatility or short-term, as I mentioned, volatility in stock prices, you shouldn't. You're getting to the point where you're not an investor. You're perhaps in some cases a speculator. And so our attitude towards hedging on the currencies is that we don't do it. And we've done a lot of studies. We do have a public website, Brandis.com. And on that website, if you look under the Brandis Institute, you can see the studies that we've done. And we've done some major studies on currencies and how currencies fluctuations for worldwide investors affect the value of those portfolios over a long period of time. And if you look at that study, you'll find out that the effect really cancels itself out for not only North American investors, but investors around the world. If you are a basic long-term fundamental and long-term, I put in there, investor, then you shouldn't worry, and I wouldn't worry about currency.
Hi, Charles. I'm Tom, and my question is, you were talking earlier about the automotive sector, and it's out of favor with even some value investors that have spoken to us. What do you see as some of the catalysts with some of your big holdings like GM and Ford?
Catalyst is something that we don't really look for, but what we look for is a somewhat normalized cycle based upon the history of the cycle in the automobile industry, and we do look for change in the extremely poor businesses such as this is, with such overcapacity problems and all the other problems that you are aware of, in the including the labor problems and pension plan problems and things like that. If a stock price gets low enough, we find them to be good values because history will tell you, and I won't guarantee you, but it will tell you that these things do turn around, and they're very cyclical, and it is a good bet when things are looking very poor. it can be a good bet to buy these companies. You can make, as an example, 3 and 4 and 5 times your money. You're taking, you are taking the bankruptcy risk and that sort of thing. But when you build a portfolio of these types of companies, and you're not overly concentrated in the automobile industry or any one area, but when you build a portfolio well diversified of all these out of favor, I find that history will tell you that you're going to do very, very well, because it's very difficult for your competitors to do this, other investors to do it, so the stock prices get too low. And we don't really know what catalysts are going to bring. We don't know what the future of the automobile industry is going to be, but on a normalized basis, we think it makes sense to be an investor there at this point. Catalysts, I don't know. Of course, as you know, General Motors is entertaining ideas for GMAC, General Motors Acceptance Corporation, their finance unit, to sell it, and maybe concentrate on automobile. And they've got a new chairman there who is starting to do the right things. And so we'll wait and see. But the opportunities there are something that I don't think a value investor should necessarily ignore. There will be some differences of opinion on value investors. One thing you should know about Graham and Dodd value investors, and you probably already know this because you've had a lot of other guest speakers, our portfolios aren't necessarily going to be alike, and we're not necessarily going to have the same companies in there. The world is a big place, and generally there is a lot of opportunities to go a lot of different areas. And if a value investor wants to redline the automobile industry, fine, that is not our opinion, but they'll probably find something else that they'd like to put in their portfolio.
Good afternoon, Mr. Brenes. My name is Chris, and my question was regarding some of the basic principles that we've learned in value investing involve knowing a select number of industries and a select number of companies. And my question is, as you've become more successful and gained more sort of renown, if you've had a lot of pressure from some of the institutional investors and as your portfolio has gotten bigger to try and maybe overextend some of the different industry that you invest in, and what sort of difficulties you've had maintaining discipline in focusing on the industries that you know best.
Yes, that's a good question too. You guys have a lot of good questions. Thank you for them. We have what we fully recognized as much as 8 years ago, a capacity problem. We have $100 billion under management right now. I used to say that was $100 billion U.S. to make sure you understood what dollars they were, because there's a big difference between the dollars. There's no longer. So I'll just say we have $100 billion under management. What we've had to do with that amount of money to put into value stocks is we can't restrict ourselves to any one area of the world. We can't restrict ourselves to any one industry. We have to be able, as a firm with that amount of money under management, to not miss any opportunities and to be able to look at all of it. So we have a research department, all Graham and Dodd, dyed-in-the-wool Graham and Dodd guys who totally believe in it, guys and gals, and there's 32 of them. And they are broken up into all of the industry categories, and of each, we will have 3 or 4 industry specialists out of that 32, and so we're covering all the industries. Some of the analysts will be multi-industry specialists, 1 or 2, but this is what we've had to do because of our inflexibility with that amount of money to place. You, as an individual investor, I as an individual investor, you, if you would be working for a money manager firm that's smaller, would have much more flexibility, actually. And you potentially then would have the ability to ignore a lot of things that go on, and you would still be able to do very, very well. We can't ignore any kind of opportunities, whether they're in South America, whether they're in Europe, whether they're in the Far East or anything like that, because of the amount of money we have under management. What we've had to do, I just might mention, is shut down the firm so we don't take any new money. As far as we don't take any new clients and we don't take any new money, because it makes it much more difficult to invest. So that's how we've handled it. We just said we can't take any more money.
Thank you.
Yeah.
Hi, my name is also Chris, and my question comes in regards to sort of a turnaround time from the point that you identify a potential buy through the screener to the point that you actually act on it. In the last couple weeks or so, we've been trying to apply the value investing principles on our own sort of selections, and I feel like I've seen our pick sort of move all over the place. And I feel like it's gone within our sort of our entry point and out of our entry point. And I was just wondering, from a professional management perspective, how fast is your turnaround time? Typically?
Yeah. Don't you hate that? We hate it. We're looking at a company. We've licking our chops. We decide, well, we're going to finish up the analysis, but we want to buy this thing. I'm sure we're probably going to want to buy this thing. We're just checking one or two more points to make sure we understand everything that's going on. And in the meantime, the stock price goes up by 20, 30%, and we've missed it. It does happen every once in a while. It's a matter of patience. Then we just move on, try to find something else. The length of time, we do a couple of things. As I mentioned before, our teams in our research department are specialized in the industry. And when they specialize in the industry, and 3 or 4 of them, they have the responsibility of really covering all the companies that would be investable by us in that industry. And they will come up and do the work, even though the price is not within an area that we would purchase it for our portfolios. They would do the work on the company, the fundamental work. We would have analysts come into the investment committee with a report on a company and saying that, well, we think the intrinsic value is $25 a share. Today it's trading at $27 a share. Well, fine. We'll put that report in inventory. And so we will have done the fundamental work, and if the stock price changes to where we might be interested, if it gets down to $20 or $15 a share, and then we can bring it out. We can do it a lot faster that way. Kind of update our information and bring it back into the investment committee. And update information might only take a few days to a week or so. To do a basic fundamental report on a company, it might take the analyst, just depending, it might take them a few weeks to maybe a couple of months to continue that report. And we're always monitoring our portfolios. We're monitoring our potential portfolios for price changes all the time. And then when the prices get to our margin of safety, we can act sometimes pretty fast.
Thank you.
Yes.
Hi. My question is regarding how do you exit an investment? Like, you make the investment, you hold it for some time, but how do you know that now it's time to exit?
Yeah, that's fairly simple, because we've got to keep it simple, because you don't really know when to exit. And so the way we do it is the basic and fundamental intrinsic value that has been determined by the analysis of the research department, confirmed by the investment committee. That price is where we would sell the stock. When it does get to that price, then there's no longer any margin of safety. Of course, it's the duty of the research analyst to come into the investment committee and say if there's anything changed. Or sometimes we'll just Instead of having a new research report, sometimes we'll just have an email from them saying, well, no, I have no reason to change. Here's what's happened. The investment committee, I would recommend you don't change the intrinsic value so that the price is there. Now we sell it. Of course, if we've owned the company, 3 years, 4 years, 5 years, the intrinsic sell point is being updated fundamentally by the analyst. He's continuing to follow the company, and hopefully we're raising the price we would sell it. Sometimes we're lowering the price we would sell it because the company's been deteriorating. But to make a hard decision easy, when it reaches our predetermined intrinsic value, we sell it, look for something else.
Mr. Brothers, this is Professor Athanasakos. I think we're getting very close to the end of our time, and I had to cut off my students here, but I have to ask you 2 questions, I guess, before we let you go. One is,
Make them easy.
what is the biggest mistake? What is the biggest mistake a novice investor can make?
Yeah, I think it's going back to what I talked about. The difference between speculation and investment. And read the first chapter. Think about Mr. Market that Ben Graham talked about. Don't let yourself become a closet speculator and don't realize that you're doing that. And I think that's one of the basic fundamental mistakes a new investor could make. And the other would be don't shorten your time period too much. This is very difficult. You buy a stock on one day, and the next day after that, you're going to be looking, where'd the price go? And that is something that you need to avoid. You need to think about this is difficult. You need to think about where the price of a company that you purchased might be 3 years from now. And that's difficult to do, but if you start thinking about it on a short period of time, that's a bad mistake.
Okay, and the last question is probably related to that one, but what is the most important thing in investing and in life you have learned over the last 30 years?
Oh boy. The most important thing I've learned over the last 30 years of investing. The basic principles and fundamentals never change.
Okay.
Thank you very much.